What if the biggest physical hub for precious metals simply goes quiet for over a week? If you follow silver, you've probably seen the phrase floating around, markets closed, Shanghai out, an 8-day window for manipulation. Asterisk. Today I'm going to translate that into plain English for a US audience. What actually changes when China's mainland markets shut down for Lunar New Year? What we can verify from mainstream reporting, and how a liquidity gap can turn silver into a headline machine. First, let's anchor this in something concrete. Asterisk reports around the Lunar New Year shutdown note that China's mainland exchange is closed for the week and that the Shanghai Gold Exchange and Shanghai Futures Exchange going offline can reduce global liquidity in precious metals, creating what one analyst called a liquidity vacuum. Asterisks. That vacuum can make prices more susceptible to sharp swings because one of the world's biggest trading and physical demand centers is temporarily absent. Now here's the key. When people say manipulation window, they're usually describing a condition, not proving intent. Asterisk. The condition is thin liquidity. Thin liquidity means fewer bids, fewer offers, wider spreads, and more sensitivity to large orders. In that environment, you can see bigger candles, faster reversals, and moves that feel unfair if you're only looking at fundamentals. And silver is uniquely built for this kind of drama because it lives in two worlds at the same time. Asterisk. It's a monetary metal that reacts to interest rates and the dollar, but it's also an industrial metal. Bullion Volt specifically notes that silver now derives nearly 60% of its annual demand from industrial uses. That means silver can swing with risk sentiment, growth expectations, and macro data just as much as it swings with safe haven narratives. So what happens when Shanghai is offline? Price discovery leans harder on the venues that remain active, especially US futures markets and London trading. And during holiday weeks, it's not only China. Trading Economics pointed out that silver slid while trading volumes were subdued due to market holidays in the US, China, and other countries. Asterisk. When multiple regions are quiet at the same time, you're not just missing a market, you're missing a chunk of the normal two-way flow that stabilizes price. That's why you'll often see the same pattern. The market opens, liquidity is thin, and silver makes a move that looks outsized compared with the day's news. Then when full participation returns, you get either a snapback or confirmation depending on whether the move was just a liquidity event or a real shift in positioning. Asterisk. Let's talk about what actually moves silver during this window, because this is where US viewers can get practical. Asterisk. Number 1. The Federal Reserve narrative. Trading Economics describes silver falling during holiday thin trade, while investors looked ahead to Fed minutes and the core PCE inflation report for clearer signals on policy. The market also reacts hard to inflation surprises because they change expectations for rate cuts. Why does that matter? Because silver competes with yield. When rates are high and real yields are attractive, non-yielding assets like metals can struggle. When investors start pricing in cuts, that pressure eases, and metals often catch a bid, especially if the dollar softens alongside yields. Asterisk. Number 2. Positioning and leverage. Bullion Volt discussed how COMEX derivatives data shows speculative positioning changing, and they also described how Chinese exchanges had tightened trading conditions around holiday risk control periods. Asterisk. When leverage is high, silver can go from quiet to violent very quickly because liquidations happen fast and margin-driven selling doesn't care about your long-term thesis. Number 3, the emotional trap of headlines. When Shanghai is closed, some people interpret any sharp drop as proof of paper games and any sharp rally as proof that the physical market is winning. The truth is usually less cinematic in thin trade. Both sides can get exaggerated. Stops can get hunted, breakouts can fail, and a single large order can print a candle that becomes a week's worth of social media content. Straubs, so is it possible for bad actors to take advantage of thin liquidity? In any market, yes. Ask, W's. But here's the important distinction. Thin liquidity makes unusual moves more likely even without coordination. That's why manipulation is a hard word to use responsibly unless you're showing evidence beyond price movement. Asterisk. A better framework for viewers is to treat this as a liquidity risk window and ask 3 questions. First, is the move happening on reduced participation? If volume and participation are lower because of holidays, the same price change may carry less informational value than it would on a normal week. Trading economics explicitly describes subdued volumes due to holidays. Asterisk second, is the move aligned with macro triggers? If silver drops right after stronger data, a jump in yields, or a stronger daughter, that's not mysterious. And if it rallies after softer inflation prints or a dovish shift, that's also not mysterious. Third, what happens when normal liquidity returns? Asterisk. The reopen period is often the real verdict. If Shanghai comes back and the move continues, it was probably more than just thin trade. If the move snaps back, it might have been mostly a liquidity event. Asterisk. Now I want to add one more layer. Even outside the China holiday, market closures matter globally. Asterisk. The London bullion market has its own holiday schedule that can reduce activity and interrupt normal benchmark publishing. For example, the LBMA noted there would be no LBMA precious metal prices published on certain late December and early January holidays, and clearing systems can close on those days too. Different holiday calendars create different liquidity pockets across the year. So here's how I'd sum it up. The 8-day window idea is really about the market structure of silver. When a major hub goes offline and other regions are also quiet, liquidity can thin out, and silver can behave like a different asset, more reactive, more jumpy, and more vulnerable to forced flows. Asgraf. That's not a guarantee of manipulation, but it is a real reason to expect volatility. If you're a long-term holder, this window can feel like noise unless it triggers margin events or shakes out leveraged players, which can set up the next leg. If you're a trader, this is the time to respect spreads, size down, and assume that stop placement matters more than your narrative. Asterisk. And if you're just trying to understand what's happening, remember, silver doesn't need a conspiracy to move violently. It just needs thin liquidity, leverage, and a macro headline. Disclaimer, this video is for educational and informational purposes only and is not financial, investment, legal, or tax advice. I am not a financial advisor. Trading and investing involve risk, including the possible loss of principal. Past performance does not guarantee future results. Always do your own research and consult a qualified professional before making any investment decisions. Ask.